Good afternoon. Good afternoon. I'm Desmond. I guess most of you know that already. And today I'm going to be dealing with Introduction to Forex Trading Part 2. And the reason why I divided it into two parts is we have new traders amongst us. We have people who are completely new to the Forex market, and I wanted them to have an understanding of the basic things, or the things that come together to make the Forex market. Some people may just start trading and then they'll go straight into it. They'll start pressing buttons on their MT5, MT4 app. That's not the right way. You first have to do your research, understand what it is you are engaging yourself into, then you move on from there. So Introduction to Forex Part 2, it's intended to be very short, just as the first one, so that the new people focus and then watch till the end. Because for new people, you can't tell what they'll do, New people, they'll be watching 1 minute, 2 minutes, 3 minutes, so I'll come back to it, and they'll quit and then they won't come back. But they are the same people who come and tell you, can you explain this thing for me? The thing that I already explained in my video. So yes, it's intended to be very, very short. So Introduction to Forex Trading Part 2, presented to you by Desmond. This is the contents. This is the contents page. This is the contents page. Building your bias, trading in lots, pips, leverage, spread, Forex orders, demo preparation, riches of Forex. Let's get straight into it. The first slide here talks about building a bias, knowing when to buy or sell. Now, before you participate in any market, before you buy or you sell any market, you first have to speculate. And speculate means to think about or to make assumptions of. Understand? So you try and make assumptions of the market price you are looking at. You try and make assumptions of, okay, I'm looking at the price right now, it is at 3216, but then I'm speculating it's going to get to 3219. That's a speculation. You are making an assumption based on the data that you have. You get it? So before you buy or sell any market, you first have to analyze it. To analyze and speculate they work hand in hand to me, because while you are analyzing, you're also speculating. Analyzing is taking the data that you have, and speculating is trying to forecast the data. It's trying to use the data to forecast future prices. So you are making an assumption based on the analysis that you have or the data that you have. And after that, you come to a bias. Now, the bias over here simply means your direction. Simply means your direction for the trade. And before you enter any trade, you have to have a direction. That's what we call bias in Forex trading. And the way it works is this. After analyzing your chart, and you come up with a buy bias or a sell bias, you go to your MT5 trader app, and then you click buy. If that's what your bias tells you, you click buy. Now, the thing about a bias is it can go either way. You get it? Market moves both sides every day, but then it moves in favor of a certain direction each day. You understand? It moves in mass favor of a certain direction each day. So every day we have buy, sell. Every day there's a buy or a sell going on in the market. Do you get it? But then your bias is what's going to tell you, okay, focus on this particular trend, focus on this particular movement. You get what I'm saying? So let's say you've analyzed your chart, you've speculated, and then you forecasted that okay, it's going to buy to this point. Then you go to the charts and then you click your buy. Now I mentioned earlier that market moves in both directions each day. You click your buy, but unfortunately for you, the trend for that day or the direction for that day is a sell. Then you click your buy and you see price going against you and putting you into drawdown, almost hitting your stop loss. You understand? So bias, having a bias or analyzing an accurate bias is very important in your day trading activity. It's one of the important things you do. So knowing when to buy, knowing when to sell, knowing when to engage in the market, and knowing when to stay away from it. Those are the things that come together to make up your bias. You understand? So that's all for that. The easiest starting point to know when to buy or sell is fundamental analysis. Fundamental analysis to me is the easiest starting point. Of course, people may argue and say fundamental analysis is very hard. You would have to do this, do that, do that. You'd have to know a lot of things. But then to me, anytime I go to the Forex Factory site and then I see a news that's about to be released, just look at the news, look at previous releases of that same news. Then I say, okay, based on this and this and this, and then the current price movement, I'm going to I'm forecasting a negative news outcome. So what happens is that when the US dollar news comes out and then it's negative, the dollar goes down, and if it's positive, it goes up. That's why I believe the easiest starting point is fundamental analysis. That's knowing, but I'm not saying just stand up and then go and then do fundamental analysis. It's not as easy as I'm saying, because I've experienced it. I know my way around it. That's why I'm saying now that it's easy. If you had met me years ago, I would have said it's not easy. Do you get what I'm saying? But the easiest starting point for me is fundamental analysis, because for that, you know that if it's negative, it's going to sell. If it's positive, it's going to buy. However, before it sells, it can buy before it sells. Do you get it? So you don't just go and then put your money in there. Do you get what I'm saying? You don't just go and then place a trade and say, oh, Desmond said fundamental analysis is easy. So I opened my trading account today, and then I slap it with a huge 0.9 lot size on an FOMC day. FOMC. You slap 0.9 as a new trader on an FOMC day. Well, beginner's luck can work in your favor, and then you make some amount of money. But if it does not, leave that to the gods. Obedantem. That's how they say it. So the easiest starting point is fundamental analysis, which means basing your trades on economic conditions of the base currency's country. So you base your trades on the economic conditions of the pair you are monitoring, the base currency's country of the pair you are monitoring. So an example is USD CAD, right? That's US dollar and then Canadian dollar. Now you look at the US and say, oh, they are in a trade war with China, they are in a trade war with this, that. For this reason, they are not going to be producing as much as they were producing when they were not in trade wars. Do you get it? Because US citizens need some things from China to be able to produce certain things, and then China gives it to them at a low price. So if China is slapping a huge tariff on that thing, just know that they are likely going to stop production, or they are going to produce less. Do you understand? So you look at things like this and say, oh, trade war is happening. This is happening. So because of this and this and that, I'm going to place a sell trade or a buy trade. You understand? So the economic events in the country, the macroeconomic events of the country. When we say macroeconomic events, we are looking at large-scale economic factors, the economic factors that affect the whole country and possibly the continent. Do you get what I'm saying? So for a country like US, it has many states. Do you understand? And then should something happen in some of the major states in the US, it affects the whole US. Do you understand? Whereas a country like Ghana, whereas a country like Ghana, the economic events happening in Ghana affects only Ghana and maybe the surrounding countries. You get it? So God forbid, let's assume there's not even an example to, let me not say this. Let's assume, anyway, forget the example. Macroeconomic events, you are looking at the overall economic events in a country. So you look at things like the labor force, you look at things like production, you look at things like import and export. You understand? So these large-scale economic events, political factors, geopolitical factors, you understand? So these huge economic events that are happening in the country, not the small one, not antennas business that has made 1,000 cedis today. That's too small an economic news to look at if you want to trade the Ghanaian cedi. Understand? So you look at the huge economic factors like I mentioned earlier, the labor force, production, import and export, political factors, geopolitical factors, the population, all these things count. You get what I'm saying? So to trade fundamentally, you have to look at the base currency. You have to examine their country, the country of the base currency, and say, okay, due to these economic factors, I'm going to take this trade on this pair. Do you get what I'm saying? So the easiest starting point is fundamental analysis, which means basing your trades on economic conditions of the base currency's country. An example is if US economy is strong, USD is likely going to appreciate, or it's likely to appreciate, whichever, Charlie. It's likely to appreciate. So then you go and buy what? You buy USD based pairs like what? USD CAD, USD CHF, USD NZD. You understand? You buy pairs like this. Why? Because you believe the economy in US is strong, and then strong economy means strong currency. So then you buy these pairs because you believe the economy is strong and is going to do well in the next however long period of time. You understand? Then if Eurozone shows weakness, that's if the macroeconomic factors of the Eurozone shows that the events happening in the country are weak, or the economic events happening in the country are weak, that means the euro is likely going to what? Is likely going to depreciate. So then you sell euro-based pairs like Euro USD, Euro GBP, Euro CAD, Euro NZD, all these amazing pairs. Now, the thing about fundamental traders is I mentioned earlier, they always have a macroeconomic perspective on the markets. They don't just go and examine antenna shop and say, oh, antenna made this amount of money today. No, they look at things like, okay, how many people were employed in January in Ghana? How many people were employed in February, March, April, May, June, July, August, September? You understand? So from this, they calculate the data they've accumulated from January to September and even October, and they say, okay, from what I have from January to October, I'm going to forecast an increase in employment in November. And then based off of this data or this intelligence I have, I'm going to buy the Ghanaian currency, that's cedi. You get what I mean? So they look at things like labor force, they look at unemployment and employment rate, they look at production, they look at import and export I mentioned earlier. They have their minds on the macroeconomic perspective of the market. So they are waiting. Is interest rates going to come down? Is it going to go up? What is the non-farm payroll going to be? That is what fundamental traders look at. Let's go to the next slide. Trading in lots. The bigger the lots, the bigger the profit and the loss. I make no mistake in saying this. The bigger the lot, the bigger the profit and the loss. The bigger the lot, the bigger the profit and the loss. The bigger the lot, the bigger the profit and the loss. What this means is it's unacceptable to just go to. It's acceptable, but it's not done. You understand? The reason why it's not done is they are not even going to mind you. You take a $1 bill and then go to the forex market and say, oh, I have this $1, I want to change it to CD. They are not going to mind you. Why? Because it's too small. You get what I mean? It's too small for them to even change. How much are they going to get on it? You understand? Whereas if someone comes to the forex bureau with $10 million, you see them gallivanting. Where are they going to get money to change this 10 million? Where are they going to get more CDs to change this $10 million? Do you get what I mean? So are they going to get this huge money to change $10 million? You know, $10 million in CDs is huge. It's like 120 million. Maybe I'm calculating right. It's like 120 million Ghana cedis. You will see them in the forex factory. You will see their veins will come out. Why? Because they know that if they are able to process this transaction and change the dollar to CD for the customer, they are going to get a huge profit off of that. I'll come to that later. So the bigger the lot, the bigger the profit and the loss. Now, because it's not done to just go to the forex market and say, oh, I want to change this $1 bill. What the system that has been put in place is we've been giving lot sizes. You get it? So the mind behind lot size is that since we don't want to be changing $1 bill for everyone who steps into the forex market, this is what we are going to do. We are going to bundle it. Then we are going to give it out to people and say, okay, the next time you come to the forex bureau, you can say, oh, I'm looking to trade. Let me use the forex market. The next time you come to the forex market, you can say, oh, I'm looking to trade a micro lot. Then do understand that you want to trade 1,000 units of that currency. So if you want to trade a micro lot of US dollar, that means you are trading $1,000. If you want to trade a mini lot of US dollar, you are trading $10,000 of the US dollar. You are trading 10,000 units of the US dollar, equivalent to $10,000. Then you come to the forex market and say you want to trade a standard lot. That means you are trading 100,000 units of the dollar, equivalent to $100,000. You get what I mean? So it's not profitable to just bring $1 into the market and then look to make profit off of that. You get what I mean? Now, for each lot given to you, it has a pip value. It has a pip value. So yes, for each lot given to you or offered to you, it has a pip value. Now what that means is that for a lot size like micro lots, each tick you see in price. So let's assume you place a trade on Euro USD, and then you place it at the price of 1.1025, and then you wait for 20 minutes, and then it goes to 1.1029. That is a 4 pip increase. So the pip is the unit, is the measurement meant per unit of price movement. So each tick in price measures 1 pip. Each tick in price measures 2 pips. Sorry, 2 ticks in price measure 2 pips. 3 ticks measures 3 pips. 4 pips measures 4 ticks in price measures 4 pips. You'd have to rewind and then hear what I mean, because I'm making small mistakes. Let me repeat myself. Each tick in price represents 1 pip. 2 ticks represent 2 pips. 3 ticks represent 3 pips. Just the same way the distance of cars are calculated in kilometers. You understand? It's the same way price is calculated in pips. We can't say price moved 70 kilometers in Monday's trading day. It doesn't make sense. Understand? The unit for measuring price is called pip. Not just in the forex market, everywhere. Okay, not everywhere, because economists have tools they use to measure the movement of these things, but then according to what we are doing, every move in price, every single tick in price is measured. Every single tick in price is called a pip. So price is measured in the unit we call a pip. So the example I gave earlier, 1.1025 to 1.1029, that's 4 pips movement in price. So now you look here, let's assume you placed a micro lot that is 0.01. Each pip movement is what? Is 10 cents. So if price moved 4 pips, that means you make what? 4 cents. Is it clear? So you go to a mini lot. Each pip movement is what? $1. So for 4 pip movement is what? $4. Then you go to a standard lot. Each pip movement is what? $10. So for 4 pip movement is what? $40. You understand? And then there's nano lots. I'm not mentioning nano lots because not all brokers offer nano lots. You get it? It's almost outmoded. Some brokers don't even have it as an option. You will not even see it. You get it? But then a pip movement with a nano lot is what? Is 1 cent. So let's assume we all place a trade and then we make 100 pips. We're able to bag 100 pips in the trading day. Someone who traded a standard lot will make 100 times 10. Will make what? 10? 100 times. Will make $1,000. My calculator is here. Hold on. 100 times 10. Yes, we'll make $1,000. I was right. Oh, I love this. You get it? So someone trading a standard lot would have made $1,000, and someone trading a mini lot would have made $100. Now, if you are trading a micro lot, you'd have made $10. So you see the difference in lot sizes. The lot sizes, placing trades with bigger lot sizes gives you the ability to make more profits and also gives you the ability to make more losses or huge losses and huge profits. You get it? So you don't just stand up and then say, oh, I'm going to trade one micro lot, one mini lot, one standard lot. No, you look at the amount of money in your account. If you have $100 account and then you place a trade, and then because you don't hear anybody, you are on your own, you don't have a leader, you don't have a mentor to tell you that, okay, do this, or let's forget mentor and leader. You've not gone to study anything, and then you just enter the forex market and you place one standard lot buy on your $100 account. That means should price move just 10 pips against you, that's the this is what I wanted to do. I'm sure you guys have seen that video before. Should price move just 10 pips against you, dead and gone. They'll swallow, they'll do your money like this. they'll swallow it, they'll put it in their stomach. Understanding pips, I explained it earlier, so I'm not going to go over it too much. A pip is a unit of measurement to express the change in value between two currencies. You understand? So currencies are always quoted in pairs. I mentioned that in the part 1 of this video, so go back and then look at it. Currencies are quoted in pairs. So Euro USD. A pip is a unit of measurement to express the change in value between two currencies. So Euro USD is at 1.1050 to 1.1051. Do you understand? The change in value between two currencies. So the two currencies this talked about is Euro and what? And USD. And then they said the change in value. So this was the initial value, that's 1.1050. And this is the new value, that's 1.1051. So the change in value, you look at this and say 1.1050 to 1.1051. How many pips did price move? 1 pip. It moved just 1 pip. Do you understand? So that's 0.0001 USD rise in value is what? Is 1 pip. Now pips are usually the last decimal place of a price quote. So what we mostly see when it comes to reading prices, they leave the decimals in 4 places. Some brokers leave it in 5 places, so 5 decimals. But then what we are used to is 4 decimal places. I brought the 5th number to explain something else to you. The 5th number is called a pipette. That is 1/10 of a pip. Do you understand? So should price move 1 pipette and you are trading a standard lot, you make $1. You understand? Should price move 1 pipette and you are trading a mini lot, you would make 10 cents. Yeah, 10 cents. Should price move 1 pipette and you are trading a micro lot, you make 1 cent. Do you understand? Should price move 1 pipette and you are trading a nano lot, I'll not even do the calculation. You know, as for you, put your close your account and go. And I'm not saying this to laugh at anybody who trades a nano lot. It's just part of the whole setup. So if you are trading a nano lot, please stick with it. Don't look at the fact that someone is trading. You see, someone is trading a standard lot and then someone is trading a micro, a mini. And then you look at all these things and say, I have nano. Someone is trading standard, so me too, I'm going to what? I'm going to trade standard. Kill yourself. You understand? You will kill yourself because your capital is not huge to stomach the losses that I'm shouting. It's not huge to stomach the losses that someone trading a standard lot can stomach. You understand? So stick with your nano until you upgrade from there. Now your upgrade can be fast. It can go from nano to a mini. It can go from nano to micro. Understand? Whichever way your upgrade comes, it comes. So stick with what you are doing. Don't look at what someone else is doing, or else you confuse yourself. That's the worst thing you can do in Forex. You look at someone's results and try and compare it to your results. Dead and gone. So most pairs have up to 4, but some go up to 2. An example is USD JPY. They quote their pips in 2 decimal places. I mentioned earlier, some brokers quote it in 5, some quote it in 3. Now, when you see a broker that quotes their pair in 4 decimal places, what they mostly do is they mostly leave the ones with 2 decimal places, they leave it to remain as that. You understand? But when you see a broker that adds the pipette, they mostly add a 3rd decimal place to the pairs that have only 2 decimal places. You get what I mean? So this is not to confuse you. They are just adding 1 decimal place, do you understand, to represent the pipette. You get what I'm trying to say? Yes. So for a pair like USD JPY, 123.00 to 123.01 is what? It's a change of 1 pip. Yes. So this is a pipette, this is a pip. Okay, this is 1/10 of a pip. This is 1 pip, this is 10 pips, this is 100 pips, this is 1,000 pips, and this is 10,000 pips. So if price moves from 1.15382 to 2.15382, that's 20. No, that's 10,000 pips. Do you understand? That's 10,000 pips. I was about to say that's 20,000 pips, but that's not 20,000 pips. That's 10,000 pips. 10,000 pips times 10,000 pips times $10 per pips. That's $1 million. You see, so if you are trading a standard lot, and then you place a standard lot of you place one standard lot on a Euro USD trade, and then it moves 10,000 pips, you make $1 million. Now if someone places this thing, is that 10,000? Yes, that's 10,000. Mini lot on a 10,000 pip, this is the amount you make $10,000. Then should you place that same trade on a micro lot, you make $1,000. You see, and should you place that same trade on a macro lot, a nano lot, you make what? Just $100. On a whole 10,000 pips, you make $100. Please, this is why I laugh at nano people. Nano for Shamo. That's all for pips. Leverage is the ratio of the transaction size to the actual cash used for margin. Leverage lets you control large positions with small capital. So what leverage is leverage is a loan. Now when we say loan, it doesn't mean when you put your money in. Okay, let's say your broker gives you a leverage, right? Your broker understands that you're a forex trader, and you move to your broker and you say, oh, I'm a forex trader, I have just $100, but I want to be able to participate in the forex market and then risk huge capital. I don't have that huge capital, but I have just $100. You get what I'm saying? So now your broker says, okay, I'm going to first ask you, how much do you want your $100 to represent in the market? Then let's assume you choose $10,000, and say, okay, then I'm going to give you a leverage of 1:100. That means per each dollar you deposit, per dollar you deposit, they're going to loan you $99 more on that dollar. So if you deposit $1, it looks as though, or it's assumed, you have $100 in your account, and if you deposit $100, it's assumed you have $10,000 in your account. Now the reason for this is so you can be able to place trades like this. You understand? That doesn't mean that $10,000 is it's not for you. You understand? It's just to give you power. It's just to give you trading power. So the leverage is a platform you stand on to be powerful in the market. You get what I mean? That's how I explained it some years ago, and then my understanding of leverage has increased so much. So I'm going to try and then make you understand it as well as I do. So for every $1 you have in the market, it represents $100. So if you deposit $100, what you are doing is you are taking a loan of what? $9,900. Yes. So if you deposit $100 in your account with a leverage of 1:100, it's assumed you have taking a $9,900 loan in addition to the $100 you have to make the total trading capital you have $10,000. Do you understand? But this $10,000, you do not see it in your account. You just see $100. But the groundwork, the inner work of what is happening is you have the trading power to move as much as $10,000 worth of contract in the forex market, or $10,000 worth of position in the forex market. Do you understand? That's how come you are able to open a mini lot. If you don't apply for a leverage of 1:100 on a $100 account, you can never open a mini lot. You'll be limited to micro and then nano. Do you get it? So the leverage you apply for is what gives you the power to open lot sizes that you would normally not open because your trading capital is too small. Do you get it? So let's assume you apply for a leverage of 1:500. That means for each dollar you deposit, the broker is loaning you $499 more. If you deposit $100, you control 50,000 worth of trading capital in the market. Do you understand? So you'll be able to open as much as 5 mini lots. Do you get what I'm saying? You'll be able to open as much as 5 mini lots. That's the max you'll be able to open, because 1 mini lot is 10,000. So 5 mini lots is what? $50,000. That means you cannot open more than that. You cannot open more than that. And if you apply for a leverage of 1:50, that means if you have $100 in your account, you control a total of $5,000 in the trading space. So you'll be able to open 5 micro lots. That's the max you can open. You cannot go to mini lots. You can never enter mini lots. Forget. You can never. Understand? I'm just doing this for the thrill of the video. You can never enter mini lots. Never. Unless you apply for a leverage that allows you to open what? To open mini lots. So I hope this one is clear. I believe I've explained it all. Anyway, let's move on. Leverage lets you control large positions with small capital. Example, with $100 and a leverage of 1:100, you can trade up to 10,000 position size. Wow, I should have changed the sign to dollars. I left it as CD. Initially, I was using CD, but I couldn't find any image that had CD as the unit of the currency. So I just left it at dollars, and then I forgot to change the CD sign to dollars. So take note, and then when you are reading and you get there, please know that it doesn't change from dollars to CD. If you deposit $1, it remains dollar. You understand? The amount of leverage you will use is dependent on your broker and what you feel comfortable with. You get it? So your brokers, like my broker, gives you as much as 1:unlimited. So that means if you have $1 in your account, it's unlimited money. It can represent 1 trillion, 10 trillion, 100 trillion, 500 gazillion. You understand? So yes, it's dependent on your broker. Some brokers, example is American brokers, I think their limit is 50. If it's not 50, it's 30. It's one of these two. It was at 1 and then they changed it to 1, so I'm a bit confused. If it's not 50, it's 30. That's the max they can give you. So Xness like this is not available in America. Why? Because America will not allow people trade on leverage that is above 1:50. No, I don't know why they do that. I think I would have to read into it and then explain to you guys that typically your broker will require a small deposit. That's a margin. Margin is the minimum amount you must have in your account for you to be able to take a trade on leverage. Let me go to the calculator and let me show you how leverage works. This is it. Let's assume you apply for 1:100 what leverage. So to know the margin required to open any trade on this account or on this leveraged account, this is how you go about it. So let's assume you apply for the words are not coming fast though. Let's assume you apply for a 1:100 leveraged account, right? To know the margin required for you to open any trade, this is how you go about it. So a 1:100 leveraged account, to know the margin required, this is how you go about it. You do 1 divided by 100, then you get your answer. That's 0.01. Then you times it by what? 100 to get a percentage. That's what? That's 1%. So if you want to open a standard lot on a Euro USD trade, they will require 1% of $100,000 at least to be in your account. So is that 100,000? That's 4 zeros. I need 5. Yes, that's 5 times 1%. Let's go. You need at least $1,000. Do you get it? You would need at least $1,000 to open a standard lot on Euro USD. At least $1,000. So your account must be more than $1,000. You'd have to have roughly $5,000 because the margin that you've deposited, the broker is not taking it. The broker is just using it as a safe deposit. Do you understand? To say, okay, I've given you a loan. Okay, let me give you a bit of history. Those days, right, brokers didn't have a margin call, stop out level and all these things. So when your trade runs against you, it can go all the way to negative. You understand? It can go all the way to negative. That means you are owing the broker. So the broker will now have to be chasing you. So what the brokers did now is that they built systems or they built things that will not allow you to put them in a negative balance. They don't want to chase you. You understand? So they built system, and then one of that system is called margin. You understand? So this deposit or this safe deposit that you have, or this deposit of $1,000 that you have in the broker's possession is just to tell the broker, okay, I want to control 100,000 worth of dollar in the trade that I'm in, right? But I don't have that money. So you know what you do? You take this $1,000 as a safe deposit, right? It's with you. You get it? Should my trade go against me and wipe out my remaining $4,000, please give me back my $1,000. You understand? That's the whole point of a margin. So the point of margin is you need this amount of money. That's $1,000. You need this amount of money minimum to open a standard lot. You get what I'm saying to you? Minimum to open a standard lot. So this trade will be running based on the $1,000 you have. So the $1,000 you have is what is running that trade. Do you understand? So if the trade goes against you, $4,000, you have $4,000 in drawdown, and then it's left to your $1,000. Remember, it's the same $1,000 that you've given to the broker to keep in their possession in case the trade is going against you. Do you get what I'm saying? So now it's left to your $1,000. There's something called a margin call level. They have a level where when your money gets to, they are going to say, no, let's liquidate this guy because is not serious, he can he can blow his account, or he can send us into negative, which you can no longer do to a broker, right? But let's liquidate this guy. Why? Because he doesn't know what he's doing, and we don't want him to lose all his account. So you know what, let's wait and see. Should the trade get all the way, should the trade be in drawdown and eat into the margin all the way to 500, we'll call him and tell him, guy, you have to deposit more money to keep this trade running, or else we'll liquidate you, we'll do you understand? That's the whole point of margin. So the margin is like a deposit. The broker doesn't take it. That means if you exit your trade, they give you back the deposit that you gave them. Do you get it? Should you win a trade, they add that money back to your account. You understand? They don't take it. They don't do anything with it. That's margin. Let's go back. So now I'm going to show you something over here. I'm going to show you something over here. Now, the margin required for currency, and then commodity is different. For a commodity like gold, the standard lot is what? The standard lot represents 100 ounces. Do you get it? The standard lot represents 100 ounces. So if you are trading if you are trading a mini lot, it represents 10 ounces. If you are trading a micro lot, it represents what? 1 ounce. You get what I'm saying? So let me liquidate this 0.01 trade. Let me close it. Now I want you to focus here. You see, I've opened a trade with a 0.03 lot size. That is what? 3 what? Micro lots. In other words, this same trade I could have opened 0.01 3 times. So that's what this thing represents. It represents 0.01 trade 3 times. You understand? Now I said the margin required for gold, the margin required for commodity is different. Okay, so now let me show you something. I hope you can see this. Can you see this? This is a screenshot I took. This is the leverage I have for the account that I just showed you. This is the leverage I have for this account. Do you understand? And then the leverage is what? 1:500. So let me calculate the margin for you. I'm going to the margin they have locked up right now for me is what? $23.86. That means should this trade go against me, it should not go below $23.68, or else they'll liquidate me. They'll do me. So let me calculate the margin for you. So I mentioned the leverage is what? 1:500, right? Let me calculate the margin for you. So 1 divided by 500 is equal to 0.002, right? Times 100 equal to 0.2. You understand? So for each trade I will open on XAU USD, they demand 0.2 margin. They demand 0.2%. They demand 0.2% of the trade I've opened, of the total trade I've opened. So let me do this calculation for you. So now, I mentioned earlier that one standard lot is equal to what? It's equal to 100 ounces of gold, right? Then my trade size is 0.03. So let's find how many ounces we are trading. So put this number in mind. Let me write it here. Put this number in mind. 0.2% is the required margin. Okay, 0.2% is the required margin to open any trade on is the required margin to open any trade on a 1:500 leverage account. Do you understand? 0.2%. I think I'm saying a lot of do you understands. So I opened a 0.03 lot size. Let me know. I want to find out how many ounces of gold I'm trading. So 0.03 times 100. Do you understand? We do this to find the total ounce of trade of the total ounce of gold I'm trading. To equal to what? Equal to 3. That means I'm trading what? 3. That means I'm trading 3 ounces. 3 ounces, right? Now let's find the notional value in dollar. To do that, we need a current price for that. So I need a current price. I need a current price. The current price is going to be this. The number you see under the XAU USD on the phone screen you are seeing here. So 3976.700. So I need a current price. That's the current price I've written. 3976.00 per ounce. That's the price I bought this trade at. Are you listening? So now I want to find the notional value. So the number of ounces I bought, that's 3 times the price per ounce at which I bought the contract. You understand? So that is what? 3976.700. How much is that? That is 11,930.1. Have you seen that? Okay, so this is the notional value. This is the how do I put it? This is the value. This is the total, the real amount of trade I am controlling with this small amount, with that $23.86. Do you understand? So to control this amount, that is the money I have to put in store with my broker. So that's the margin you can see. And then under it, I have free margin. That means I have 290 fluctuating. You see that number is fluctuating. 290 fluctuating more to place what? More trades. But I want to get you to how they calculated the margin on. Guy, let me liquidate this thing. It is causing me a headache. So I want to get to the shit, I shouldn't have done that. Because I'm using it to teach. What the fuck, man? You see, traders, this is what you go through. Sometimes you just see the trade and the way it's coming down is scaring you. Then all of a sudden you do or you close the position. Meanwhile, it's a good trade. You understand? This is a demo account. I was using it to teach you. I should have just left it because it won't cause me any harm. You understand? But I closed it. I'm going to open it again. I'm going to open it again. And you can see that they've done what? They've taken the same margin from my account. Do you get it? So now 11,930.1. Now what do I do with that? To calculate the required margin, you now do this times this number by what? 0.2%. Do you understand? And look at what we have. Buying. And you see that 23.86. Same thing over here. Okay, the reason why this one has changed is the price. Can you see that the price I bought this one is different? So now let's go back. 3 times 3980.950 is equal to what? Is equal to 11,942.85 times 0.02. Sorry. 0.2%. Now you can see that, it tallies. You see that it's equal. They rounded it, so the 5 is now what? Is now 9. So 23.89. Spent too much time on leverage and all this bullshit. Let me go on. So that's leverage and then margin. Spread. So forex brokers usually quote two prices for a currency pair: the bid price and then the ask price. The bid price is the price at which you can sell the base currency. The ask price is the price at which you can buy the base currency. The difference between these two prices is what? Is the spread. Now, as you can see over here, USD BGN. The bid price for USD BGN. So the bid price is this one. The bid price is the price at which you can sell. And then the ask price is the price at which you can buy. Now, USD BGN is trading at 1.6996 for the bid, and it's trading at 1.7044 for the what? For the ask. How much have they added? Away. Guys, the spread for USD BGN is 48 pips. The spread for USD BGN is 48 pips, and then the spread is basically the transaction cost. That's what the broker eats. Do you understand? That's the amount he gets from facilitating or running the transaction for you. You get it? So it's done by the broker selling the currency to you for more than they pay to buy it. Shouldn't have done that. And also buy from you for less than they will receive when they sell it. So this is how it works. Let's go back to the phone, and let's go all the way to the what? To the 1 minute time frame. The bid is the green, and then the ask is the what? Okay, so the bid is the green, and then the ask is the what? Is the red line. I hope you can see that, right? Now, if I want to sell, I would have to sell at okay. If I want to sell, I would have to sell at the green, even though what? If I want to sell right now, right, then I place the trade. I want to sell right now and then I place the trade. They are going to fill me in at what? I'm trying to catch one number. Okay. So if I want to sell, they are going to fill me in at, see, let's just use the green line. They are going to fill me in at the green line. You get what I'm saying? Even though price is what? It's at the red line. You get what I'm saying? So that small space in between is the spread. So the difference between the green line and then the red line is what? Is the spread. And if I want to buy, they are going to fill me in at what? At the red line. So already I'll be in a loss. Do you understand? I'll be in a loss because I've been filled at the red line and price is currently trading at what? At the green line. Do you understand? So that's the spread. Forex orders. Forex orders, buying and selling. Now, an order is an order. What do you understand by order? You should go and order somebody. Hey, bring me that thing that you have over there. If you meet Kwashebo in town in the evening, he orders you to give him your phone. You understand? He doesn't He doesn't come in, oh, me pacho, mami, phone. He orders you to give it to him. And if you don't give it to him, face the what? Face the English is not coming, the repercussions, or say the consequences, you see. Yes. So that's an order in the forex market. So what you do with an order is you tell the broker that this is what I want you to do at this specific point or at this level. You get what I mean? So let's go through some of the orders. An order tells your broker how and when you want to execute your trade, just like when the Kwashe boy meets you. He tells you how he wants the phone from you. You understand? He doesn't want you to, some of them don't even want you to log out your iCloud. They just want you to give them your phone. You understand? Some of them will meet you and they will let you log out your iCloud before you. Can you imagine? Very disrespectful. They'll let you log out let you log out your iCloud before you give them the phone. That's very disrespectful. Unless we fight, I will fight you. Just playing, Charlie. You understand? How and when to execute your trade. So then a market order. A market order, I'm going to go through some types of orders, right? A market order makes you execute the trade immediately at the current price. At the current price, it makes you execute the trade immediately. You understand? You execute it immediately. So let's assume price is trading at 1.1067, and then you press buy. They fill you in immediately. That's market order. Market execution, they fill you in, back, then you are inside the market. Then the next one is what? Is limit order. Let me charge this microphone. Guys, I didn't tell you what happened to me. Hold on. Yes. So I recorded this session midnight, right? I recorded it started from 2 o'clock. I ended at 3:40 something, right? 3:40 something. No. Just to realize my microphone went off. The battery was low. Oh my God. So it be only 20 minutes where you go feel hear my voice for inside. The rest is baller. Somebody that I've stayed up late to do this thing. Then I was like, oh no, yawa. So it was 3 something. And I was like, I'll record it again. I recorded it again. Now I forgot to flip the slide because I forgot to flip the slide. I finished recording another 1 hour something minutes. Then I checked the video again and I realized, oh my God, what in the world is this? Like, do you get what mistake is this? Just close the laptop and I went to sleep, Charlie. So I had to charge my microphone because I'll repeat that same mistake and I don't like it. Because the value I've put in this video, oh my God, unless I cancel this whole thing. So yes, market order immediately, and limit order executes. You order the broker to execute your trade for you only when price reaches your chosen better price. So I'm going to elaborate more on the limit order. For limit order, we have buy limit and then buy stop. Understand? So let's assume, let me use the phone again. Let me use the phone again. So currently, market is, or price is going up, right? Price is going up, but I don't like the price is trading at right now. And I say, okay, I want to enter a limit order so that when price gets to a better price, when the value of gold gets to a better price, it fills me in at that price. Just the same way your mom goes to the Antamanto and then something that they sell at 130 cedis, you start bidding at 12 cedis, sometimes 3 cedis. That's where she'll start bidding at. You understand? Mothers are wild. See, I don't know about everybody else, but mothers do this thing better than fathers. That's what me have seen. That's what my father, you will not go and then you'll be talking plenty. If you say it is this, he will tell you, oh, I'll give you this. Then you will say, oh, I don't like this, I like this. Then you think, oh, I'll give you this. This is what I want to give you. Then you do some 1 minute argument and then you will settle it. But mother will now take chair and sit down. Okay, they will say 150. Remember our 30. Remember our 13 CDs. Something that is 150. You started bidding at 13 CDs. Understand? That's how it works. So a buy limit order is just you telling the market. You are telling the broker that, see, all this shenanigans that is happening in price, I don't care, Charlie. Yeah, I want to buy at 3967.600. So how you do that is you come here and you pull your buy limit all the way here, 3967.600. Let me leave it at 609. Then you place the buy limit. So you see this order, it has not been triggered though. It's there. You see, placed, it's there. All we are saying is, broker, all these things happening in price, I don't care. It's not my concern. All I want is when price gets to this point, fill me in. That's all I want to see. You understand? And then a sell limit order is okay. In the long run, let's go to the daily. In the long run, price has been coming down, right? Price has been coming, but I don't want to sell my contract for when the price of it is very, very cheap. I want to sell it when the price of it is high. So what you do is you place a sell limit order above the current market price, such that when it gets to the specified price, your broker should fill you in and then take your trade down and then book your profit for you. So buy limit order is placed below the current market price. Sell limit order is placed above the current market price. You get it? So you want to execute your trade when it is at a better price, when you like that price. You understand? That's the whole point of limit order. Then a stop order. A stop order executes once price passes your set level. So a stop order is you set. I'm just going to explain this. You see price trading currently, right? Price is falling, and then you say, price is falling, right? I don't believe price is going to fall all the way down, but you know what? If price breaks below this level, that means it's going to go all the way down. So you know what? I'm going to put my sell stop over here, such that when price falls and then it gets to this point and it hits my sell stop, it should take me down. You understand? This time you are not placing the order above the current market price to wait for price to go up before it takes you down. You are placing it below the current market price because you believe if price breaks this level and gets here, it's going to what? It's going to continue going down. So you want what? You want market or your broker to fill you in at this price. You get what I'm saying? Yes. And then a buy stop is placed above the current market price. You believe price is going to continue going up, but then right now it has not gotten to this level. You believe if it gets to this level and breaks this level, it's going to what? It's going to continue going up. So what you do is you set your buy stop above the current market price. Let's assume current market price is here. It's my right hand. That's the hand that is shaking. Is here. Understand? So I set my buy stop order here. That's my hand that is shaking. That's the buy stop. I set it here. Then I'm saying if price is going up and it's going up and it's going up, and then it reaches here and then it hits this amount, I believe it's going to continue going up if it hits this amount. So you know what? I've set my buy limit here. When it hits this amount, fill me in and let price just go to my way. You understand? Stop loss order. It's an order you place in the market to automatically close your trade if it moves against you beyond a certain limit. So let's say you are in a buy trade, but then price is going down. So if you are in a buy, you place a buy trade here, price is supposed to go up, right? But it's not going up, it's going down. Then you place a stop loss order here. Let's say let's use this part of my body as the stop loss order. And then price goes all the way down, and then it hits this level. That's an order telling your broker that immediately it hits this level, please take me out of the trade. Why? Because I don't believe it's going to turn from there. It's just going to keep going down, and I don't want to lose all my money. So you know what? When it gets to this level, take me out. The same is true for The opposite is true for take profit. Do you understand? You take a buy trade over here, your take profit is over here, price goes all the way here. You are telling your breaker, when it gets to this place, I don't believe it's going to continue going up, or maybe I believe it's going to continue going up, but for me, I want it to get here and then you take me out. So you set your take profit over here, price gets to this place. When it gets to that place, the broker would liquidate your the broker closes your trade and then gives you the profit. Demo trade your way to success. I couldn't wait to get here, guys. Just like anything in this world, you see, just like anything in, like an example is you go to uni, you are in uni, your first semester. After your first semester, they'll tell you to go and do internship, right? Why? Because they want you to have a feel of the work you will be doing after the school. When you complete, you understand? So you'd have to be practicing. So if you are studying HR like me, you have to be going for internships. You go first one, second one, third one, fourth one. By the time you are done with the school, you have a pool of experience that you can tap into. You can get idea from many places. Do you understand? It's the same thing for demo trading. Please demo trade if you are new. Demo trade if you don't have a system now and you are building a system. Demo trade a system. You get it? Demo trade. Practice until you are fine, or until it's proving that the strategy or the system you are using is giving you profit consistently. That's when you move to live trade. So just like any other endeavor, you need to practice first, and a lot, to get what you are doing. Demo trading allows you to practice strategies, gets you familiar with the market without risking real cash. So you don't risk real cash on a demo trade. It's just a practice account. Do you get it? How long should you demo trade? Until you have built confidence enough to step into the live arena. If you've not built your confidence, please don't step into the live arena. What practicing you know what? Practicing in boxing and going to face your opponent's real life is two different things. So yes, if you have confidence in practicing, then you have a high probability of winning. But if you've not practiced to a place where you feel confident and go and stand in front of your opponent like this, all you'll be seeing is black and blue on your eyes like this, because it's giving you real life situation. It's not giving you practice, so he's giving you to knock you out. He wants that $10 million that they've promised him he will get if he beats you. So he's giving your face. You see boxers, their ears are sore, they punch their ears. Their ear cannot hear anything again. You understand? That's the difference between demo and live trading. If you've practiced enough and you are confident, you've tested your system, you've tested your strategy, you've tested your plan, and then you're confident enough, then you can step into live trading. Until you have consistent results from testing out your strategy. So you still have to have consistent results from testing out your strategy before you enter into a live account. It's important to stick to one pair or instrument when trading demo. The reason is, when you are trading demo, you have to stick to one pair to become familiar with the price action. Do you understand? If you don't become familiar with the price action of just one pair and you are monitoring 17 pairs, you would look at this one and say, oh, this one correlates with this one. So if this one is doing this, that means this one is going to do that. And then you take your trade based on what you've seen in another price action. You kill yourself, especially on a live account. You kill yourself, you understand? Remember, demo trading does not perfectly replicate the emotional and psychological pressure of live trading. I mentioned it earlier. The fact that you are doing demo trading doesn't mean it's perfect. The emotional, like what I did when I closed the trade. I don't know. I don't believe in coincidences, do you understand? But then it had to happen for me to be able to explain this well, you understand? I saw that money coming down, even though it's a demo account. I saw it coming down. And it reminded me of some loss I chopped before. So I'll look at the tracer and this thing is stressing me. Let me just close it. I've forgotten it's a demo account. Do you understand? I've forgotten it's a demo account. That's why when you're trading, you have to have your rule book beside you. You have to be looking at it. When price is doing something, you look at the rule book and say, okay, this is what I'll do when price is doing this. You understand? You look at your plan, you position yourself. You understand? So demo trading does not replicate the emotional and psychological pressure of live trading. It never does. It just gives you a feel, and it gives you a result of your system. So if your system is good, if your strategy is good, then guess what? Your profit will be good when you come to live trading. Riches through trading. This is the last slide. The long game. The market is easily accessible to all individuals, even those with the smallest amount of capital. The reason why I named this last slide Riches Through Trading, or this last page Riches Through Trading, is because Forex is accessible to everybody. You can make money even with a small amount. You understand? You can become rich with a small amount. You get it? So because it's accessible to everyone, yes, you can. It offers the potential of high returns due to leverage and market volatility. It is important to consider the following before starting out. Now, the trading is not a get rich quick scheme. I keep saying this to everyone who asks me about trading. I don't say anything without saying it's not a get rich quick scheme. Do you understand? One of the guys in the group was texting me, telling me, what does he have to do? Where does he have to deposit? I say, relax. Watch the videos. Gain understanding. You understand? It's not a get rich quick scheme. It's not something that you do giddy. Yes, you should have your accounts. You should have this and that. It's not something you do giddy for. Understand? So relax. Forget all you're seeing on social media. Trading promises riches, true, but then to get there, you have to go through a lot. You understand? Trading will have to break you and mold you to what it wants you to be before you can even start making consistent profits. You get it? So yes, that is it. It's not a get rich quick scheme. You have to take your time. You have to practice. You have to have patience. Yes, all traders lose money. Yes, everybody, every trader, even Larry Williams, he loses money. He loses money. Me, I lose money. You understand? So don't look at it and say, oh, because you are learning from Desmond, you'll be making tens of thousands or millions of dollars. No. The thing is, we have a system. The system is profitable, and that's what we are going to follow. Yes, the system makes millions of dollars, but that's the same system has faults, and you can chop loss inside. You understand? But the probability at which we win is higher than the probability at which we lose. So it is proving to what? It's proving to give us money, or it's proving to generate money for us in the long run. Do you understand? So all traders lose money. Don't come thinking you never lose money, all your trades will be perfect and all those things. This is due to lack of planning or training. I mentioned earlier, you have to have a trading plan. You have to train on demo accounts. Indiscipline. You tell yourself you trade the New York session. You see a setup in the London session. Giddy. You take your phone. Not disciplined. Market to useless you and to wash you. Greed. Guys, for those who are now coming to start trading, I used to think I'm not greedy until I entered the forex market. I used to say, oh, me as for media, I be good guy, you understand? I don't be greedy. I shut down pay me racer till I entered the forex market. Boy, my profit target is $160, right? But then and price has hit my profit target, right? But then I'm waiting for more. Okay, let me wait till it gets to 200. Let me wait till it gets to 220, 230, 250. Then I remove the money. Greed will kill you. Understand? it gets to your target, remove it. Don't allow greed to mess you up. Understand? To effectively trade forex, you must have some sort of income to quench the need to make home run trades. Yes, you have to have some source of income. You have to have something that, okay, you even forget source of income. Let's say you've deposited your money, right? Have some money aside that you used to eat and used to do your transport and all these things, because you end up putting pressure on the account. This account has to generate this amount of money for me to do this. Like, you're putting pressure on the account, you blow your account. While getting rich is possible, it is important to approach it with caution, realism, and a long-term mindset. If you have a long-term mindset, the learning curve will be easy for you. You will not be watching. You know how many videos. You know how many hours long videos I've had to sit through to learn this. My mentor can do 6 hours lecture, and then I'll just be sitting and I'll just be hearing him. My head will be aching me. You see that headache that when it happens to you, you have to be coping with it. So some headaches hit you, like it hits you hard. So you have to be like it. You have to be going down with it like that to be able to cope with it, and of course it's doing something to you. You understand? So yes, if you have the long-term mindset, you'd not concern yourself with how long it's taking. You only concern yourself with how good you've, or how you've improved over the past days or since you started. You understand? So there's nothing to rush about when it comes to trading. Approach it with a realistic mindset. Okay, I'm going to lose money, but my system has proven that it can make me money. So this is what I'm going to approach trading with. And then I'll approach it with caution too, because it's a risky market. The fact that people are making money from this market doesn't mean it's not risky. It is very, very risky. People trade and kill themselves because the market swallows all their money. Understand? So that's all for today, and thank you for watching. Again, presented by Desmond Kidd, and thank you very, very much. That is all for today.